In 2008, right before the financial crisis, a man named John, an average American office worker, decided to get serious about investing. He had been saving for years, watching the market from the sidelines, and finally felt ready. He invested a large portion of his savings into the stock market. Then the crash came, his portfolio dropped 30, 40, almost 50%, panic set in. Every day, the news got worse. Headlines screamed recession, collapse, uncertainty. John couldn't take it anymore, so he did what felt safe. He sold everything, locked in the loss, swore he would wait until things are stable again. Fast forward to 2010, the market had already started recovering, but John didn't re-enter. It's too risky, he thought. Then 2012 came. Then 2015, the market kept going up. Eventually, in 2017, after hearing everyone talk about easy money, John got back in, near the top. Then 2020 hit, another crash. Guess what John did? He sold again. Now here's the shocking part. While the S&P 500 returned roughly 9 to 10% per year over long periods, John's actual return, barely 1 to 2% per year. Sometimes even negative, and John is not an exception. He is the average investor. The 8% gap, where does it come from? Studies, like Dalbar's famous research, consistently show, backhand index pointing right, the average investor underperforms the market by about 6 to 8% per year, not because they pick bad investments, but because they behave badly with good investments. This is the key idea. The biggest risk in investing is not the market, it's your own psychology. Part 1, the common mistakes. Let's break down what investors like John typically do wrong. 1. Buying high, selling low. This sounds obvious, but emotionally, it feels completely logical. When markets go up, confidence rises, people buy. When markets crash, fear spikes, people sell. So most investors, backhand index pointing right, enter near the top, backhand index pointing right, exit near the bottom, not because they're stupid, because they're human. 2. Chasing performance. Investors love what's already working. Tech stocks after they explode, crypto after headlines go viral, hot funds after 3 years of strong returns. They assume, since it went up, it will keep going up. But markets don't reward past performance. They punish late arrivals. 3. Overtrading. Many people feel like, if I'm not doing something, I'm missing out. So they check prices daily, trade frequently, react to every piece of news. This creates backhand index pointing right fees, backhand index pointing right taxes, backhand index pointing right emotional exhaustion, and worst of all, backhand index pointing right bad decisions under pressure. For trying to time the market, I'll sell now and buy back cheaper. Sounds smart, almost never works, because to succeed, you must be right twice: when to get out, when to get back in. Missing just a few of the best days in the market can destroy long-term returns. 5. Lack of a system. Most investors don't have a clear plan, no rules, no structure, just backhand index pointing right, I feel like buying. Backhand index pointing right, I feel like selling, and feelings are the worst financial advisor. Part 2, the root causes. This is the real problem. These mistakes are just symptoms. The real issue is deeper. 1. Fear and loss aversion. Humans hate losing money more than they enjoy making it. Psychologists call this backhand index pointing right loss aversion. A 20% loss feels twice as painful as a 20% gain feels good. So when markets fall, backhand index pointing right, the brain goes into survival mode. Backhand index pointing right logic shuts down. Backhand index pointing right emotion takes over. Selling feels like relief, even if it's the wrong move. 2. Herd mentality. People feel safer doing what everyone else is doing. When everyone is buying, it feels safe to buy. When everyone is panicking, it feels safe to sell. But in markets, backhand index pointing right, the crowd is usually wrong at extremes. 3. Short-term thinking, investors say they're long-term, but act short-term. They check portfolios daily, react to weekly news, judge results monthly. Markets are volatile in the short term, but predictable in the long term. This mismatch creates bad decisions. 4. Need for control, doing nothing feels uncomfortable, so people act, even when action hurts performance. Ironically, backhand index pointing right, the best investors often do less, not more. Part 3, How to fix it. This changes everything. Now the important part. How do you close that 8% gap? 1. Build a simple system. Instead of reacting emotionally, create rules. Example, invest monthly, no matter what the market does. Allocate 70% index funds, like SP 500, 20% international, 10% cash or bonds. This is called backhand index pointing right, system-based investing. You remove decisions, and therefore remove mistakes. 2. Automate everything. The best way to avoid bad behavior, backhand index pointing right. Don't rely on willpower. Set up automatic transfers, automatic investments. Money goes into the market before you can think about it. 3. Stop watching the market daily. More information is not equal to better decisions. It creates stress, and stress leads to mistakes. Instead, backhand index pointing right. Check your portfolio quarterly, or less. Let time do the work. 4. Reframe market crashes. Most investors see crashes as danger. Smart investors see backhand index pointing right discounts. When the market drops 30%, bad investor, I'm losing money. Smart investor, stocks are 30% cheaper. Same event, different mindset, different outcome. 5. Think in decades, not days. The market is unpredictable in 1 year, but much more predictable in 10 to 20 years. So ask yourself, backhand index pointing right, where will this be in 10 years? Not, backhand index pointing right, what will happen next week? 6. Accept that you are the problem. This is uncomfortable, but powerful. You don't need better stock picks, better predictions, better timing. You need backhand index pointing right, better behavior. Final thought, this is the lesson. The difference between a 2% return and a 10% return is not intelligence, it's discipline. John didn't fail because the market was bad. He failed because, backhand index pointing right, he reacted instead of following a system. Backhand index pointing right, he followed emotions instead of rules. Backhand index pointing right, he tried to be smart instead of being consistent. If you remember one thing from this video, let it be this: the market rewards patience, but punishes emotion, and the moment you stop trying to outsmart the market, and start controlling your behavior, that's when investing finally starts working for you.